There is a quiet unease that settles sometimes, a whisper in the financial winds that the headlines refuse to acknowledge. You feel it in the pit of your stomach, perhaps when the market seems to defy gravity, or when the pronouncements of stability ring hollow against your own intuition. It is a profound frustration, this sense of being adrift in a sea of conflicting information, where every expert offers a different map, none of which seem to guide you to the true north of sustainable wealth. This feeling of uncertainty, this fear of making a costly mistake, it is not a weakness. It is a deep, human response to an opaque world, a world that often obscures the genuine mechanisms of financial health. Perhaps you have carried the weight of past financial disappointments, or the silent burden of preparing for a future that feels increasingly unpredictable for yourself, or perhaps for those you love, like a child's education or a secure retirement. This anxiety, this longing for clarity, for a data-driven truth that cuts through the noise, is a valid and powerful human experience. We are told to watch the stock market, to follow the interest rate hikes, to track GDP. But what if these widely broadcasted signals are merely the surface ripples, missing the deeper currents that truly dictate the economic tides? What if the conventional wisdom so readily offered is designed to keep us looking in the wrong direction, distracting us from the subtle tremors beneath our feet? This is not about fear-mongering, it is about seeking an honest reflection in the mirror of economic reality. It is about understanding that true financial mastery comes not from reacting to the obvious, but from anticipating the unseen, from listening to the market's deeper whispers. Today, we journey beyond the headlines, beyond the superficial indicators that clutter our screens. We will demystify 5 economic indicators, often ignored, often misunderstood, that offer a more profound insight into the health of our financial landscape and, crucially, suggest the approach of the next recession. This exploration is not merely an academic exercise. It is an act of empowerment, a path to informed decision-making, designed to equip you with the clarity and confidence to navigate the coming shifts. We are uncovering the hidden truths behind wealth accumulation, understanding that to build sustainably, we must first see clearly, with eyes unclouded by market noise or conventional narratives. Don't just invest, understand the why behind every decision, allowing your actions to be rooted in a deeper, more resilient wisdom. There is a moment of quiet dread when the bond market begins to whisper a truth that the equity market often refuses to hear. We observe the yield curve's inversion, where short-term bonds offer higher yields than long-term ones. Yet, simply seeing this inversion is like hearing a single note from a complex symphony. It is the silent scream of the bond market, a profound signal that capital is fleeing to safety, discounting future growth expectations. This reflects the market's collective fear, projecting a slowdown, moving money from riskier long-term ventures into the perceived stability of short-term government debt. It is the financial world's deep breath before a plunge, an echo of what Benjamin Graham might have called the underlying reality beneath fleeting sentiment. But our human minds, in their intricate dance with emotion, often fall prey to a behavioral echo chamber. Overconfidence and anchoring to recent market highs lead us to dismiss these early warnings as anomalies. We wait for official declarations, for the recession to be undeniably asterisk here asterisk, rather than acting on the nuanced foresight the yield curve offers. How many times has an initial inversion been dismissed, only for its prophecy to unfold months later, leaving many unprepared? The true edge lies in listening, in trusting the data even when it contradicts prevailing optimism. Moreover, not all inversions are created equal. This is the duration and depth fallacy. A fleeting, shallow inversion differs significantly from one that persists for months, deepening its spread. We must consider the magnitude and persistence of the inversion, and keenly observe the term premium, the extra compensation investors demand for holding longer-term bonds. When this premium vanishes or turns negative, it signals genuine distress, distinguishing noise from authentic recession signals. To move from reactive to proactive, consider a 3-step framework. First, monitor the 10-year, 3-month Treasury spread for consistent inversion. Second, cross-reference this with other fixed-income indicators like corporate bond spreads. And third, use these combined signals to guide portfolio adjustments, perhaps reducing cyclical exposure or increasing cash reserves. The bond market, in its wisdom, acts like Cassandra, the mythological prophetess. It speaks truth, clear and stark, yet is often disbelieved until disaster strikes. Understanding its language grants you a critical edge, allowing you to navigate the future with informed conviction, rather than being swept away by the tide of conventional neglect. What truths are you overlooking in the market's quiet counsels? There is a palpable tightening in the air, a subtle shift in the market's breath that often goes unnoticed by those fixated on daily stock movements. This is the story told by credit spreads, the unseen thermometer of market fear and capital allocation. It's the hidden premium that lenders demand for trusting a company with their money, beyond the risk-free rate of government bonds. When this spread widens, it's not just a number. It's a real-time gauge of perceived risk, a reflection of the true cost of doing business, and a clear signal of capital's growing hesitancy. It tells us about the willingness of institutions to extend credit, a foundational pillar of economic activity. Yet, many investors fall into the search for yield trap, a dopamine-driven pursuit of returns in seemingly benign credit environments. They ignore widening spreads, mistaking readily available liquidity for underlying solvency until it is too late. This cognitive bias leads to catastrophic misallocations, a painful truth for those who learn it firsthand. They believe the market will always provide, overlooking the subtle tremors that precede a quake. We are uncovering the hidden truths behind wealth accumulation, and this truth often lies in understanding fear, not just greed. Widening credit spreads are more than just about interest rates. They are a sophisticated proxy for future corporate defaults and broader economic contraction. These shifts often precede equity market downturns by several months, offering a crucial early warning. It's a signal that the cost of capital is rising, that businesses face tougher times, and that the financial fabric is under stress. To move from signal to strategy, consider monitoring key credit spread indices, such as the ISBOFA US High Yield Index Option Adjusted Spread. Integrating their movements into your risk management framework allows for tactical asset allocation, shifting towards more defensive positioning when the market begins to show its cracks. Just as geological fault lines reveal underlying tectonic stress, credit spreads expose the systemic vulnerabilities that build beneath seemingly calm markets. They offer a critical early warning for the discerning investor, for those willing to challenge the consensus and find their edge. Ignoring these fault lines is to build on shifting sand. What quiet anxieties are the credit markets revealing to you if you choose to listen? Beyond the vibrant hum of consumer spending, there lies a quieter, more ominous hum, the sound of warehouses filling. The market's gaze often fixates on the immediate, on the fleeting joy of a shopping spree, but the deeper truth whispers from dusty shelves. This is the warehouse warning, an increasing inventory to sales ratio, particularly in cyclical sectors, signaling a fundamental slowdown in demand and impending production cuts. It's a crucial indicator often missed by analyzers that prioritize headline consumer spending, overlooking the profound shift in the underlying economic metabolism. This isn't merely about unsold goods, it's a signal of a deeper malaise, a pause in the flow of capital and consumption. Companies, caught in the relentless cycle of quarterly expectations, often fall prey to the growth at any cost illusion. They overlook the rising tide of inventory, hoping demand will eventually catch up, dismissing the early signs of saturation. This overconfidence leads to forced price cuts, margin compression, and ultimately a ripple effect of reduced investment and employment across the economy. It's a painful consequence of delaying an inevitable adjustment, a testament to how human biases can cloud even the most rational corporate decisions. This frustration of seeing the obvious ignored is a shared burden, a common thread in the tapestry of market misjudgment. Think of the bullwhip effect in reverse. Small changes in end-user demand are amplified up the supply chain, from retailers to wholesalers to manufacturers. This leads to significant inventory imbalances, accelerating economic contraction as companies scramble to adjust production. It's a cascade, a domino effect where a slight hesitation at the checkout counter becomes a torrent of unsold goods upstream. To truly see, we must track granular inventory levels and sales figures, looking at manufacturing and trade inventories, wholesale inventories, and retail sales data. These numbers offer early signs of demand destruction long before it fully impacts corporate earnings and GDP reports. An economy, much like a body, can only digest so much. When it produces more than it can consume, it chokes, leading to a necessary, often painful, cleanse. This economic indigestion impacts asset valuations across the board, forcing a re-evaluation of what is truly sustainable. Are we truly listening to the quiet struggle of the supply chain, or are we still captivated by the surface-level hum of immediate consumption? There is a quiet dignity in the concept of home, a place of safety and aspiration, but its financial underpinnings often whisper truths about the broader economy that go unheard. Metrics like housing starts, building permits, and existing home sales are not merely statistics about real estate. They are the bedrock indicators, reflecting deep-seated consumer confidence, the availability of credit, and future employment trends. They act as a foundational economic barometer, a pulse check on the nation's willingness to invest in its future, to build and to settle. When these numbers falter, it is a signal that something fundamental is shifting beneath our feet. During periods of booming housing, we often fall prey to the home as an ATM fallacy. Driven by confirmation bias, investors and consumers ignore the growing strains of affordability and the subtle creep of rising interest rates, believing that real estate always appreciates. This leads to the perpetuation of unsustainable cycles, a collective delusion that the current good fortune will last indefinitely. This blind spot, born from hope and past experience, can be profoundly painful when the inevitable adjustment arrives, leaving leaving many feeling exposed and vulnerable. The ripple effect of rising mortgage rates is profound. It's not just a higher monthly payment, it's a significant drag on affordability, dramatically slowing transaction volumes and impacting the wealth effect, that feeling of financial security derived from rising home equity. This widespread impact on consumer balance sheets and their willingness to spend acts as a powerful brake on broader economic activity. To gain a clearer vision, cultivate your own housing market dashboard. Monitor leading indicators such as the NAHB Housing Market Index, which gauges builder sentiment, MBA mortgage applications for demand insights, the momentum of the Case-Shiller Index for price trends, and various housing affordability indices. These tools help forecast shifts in consumer spending and even the health of the banking sector. Like a crack in the foundation of a house, issues in the housing market often signal deeper structural problems in the economy. They demand our attention before the entire edifice trembles, affecting portfolios and livelihoods with a pervasive tremor. Are you truly examining the foundation of the economic home, or are you distracted by the decorative facade of recent gains? While the grand narratives of the stock market often capture our attention, the true pulse of the real economy often beats in a less observed corner, the small business sector. This is where the NFIB Small Business Optimism Index becomes a profound whisper, offering a ground-level, unfiltered view of economic health. It reflects the raw, unvarnished intentions of entrepreneurs regarding capital expenditure plans, often reacting faster and more organically than the polished reports of large corporations or government statistics. It's a barometer of real-world confidence, untainted by the financial engineering often seen in larger entities. Mainstream analysis, however, frequently falls prey to a big company bias. It focuses on large, publicly traded corporations, overlooking the collective sentiment and investment decisions of small businesses that, collectively, drive the majority of job creation and local economic activity. This oversight is a significant blind spot, causing many to miss the early tremors of economic shifts simply because they are looking in the wrong place. The pain of feeling overlooked, of having one's contributions minimized, is a common human experience, and in finance, it can lead to profound misjudgments. A sharp decline in small business capital expenditure intentions, born from fear and uncertainty, is a capital allocations canary in the coal mine. This signals a profound lack of confidence in future demand, leading directly to reduced hiring, slower innovation, and a broader economic contraction. It is a painful truth, often obscured by the glitter of large corporate earnings, but it reflects a deeper reluctance to invest in the future. To truly understand, we must look beyond the headlines, interpreting the granular subcomponents of these small business surveys, examining hiring plans, inventory expectations, sales forecasts, and compensation plans. These details provide a nuanced understanding of economic momentum and future direction, offering a clarity that top-line figures often lack. Just as a forest's health is often best judged by the vibrancy of its undergrowth, the true strength and future direction of an economy are reflected in the confidence and investment decisions of its agile, entrepreneurial small businesses. These are the roots of prosperity, and when they begin to retract, the entire economic tree feels the stress. Are we truly listening to the quiet resolve or the growing trepidation of those who build from the ground up? We have journeyed together beyond the obvious, seeking the deeper rhythms of the economy, the quiet truths often obscured by the clamor of daily headlines. We have seen how the nuanced whispers of the asterisk yield curve asterisk offer a silent scream from the bond market, how asterisk credit spreads asterisk act as an unseen thermometer of fear, how a growing asterisk inventory dash-to-dash sales ratio asterisk echoes warnings from warehouses, how asterisk housing's hidden hand asterisk reveals the bedrock of consumer confidence, and how the asterisk entrepreneur's retreat asterisk in small business sentiment provides the most honest pulse of the real economy. These are not isolated data points, they are threads in a tapestry, collectively revealing economic shifts long before the consensus awakens. The conventional narratives often keep us tethered to lagging indicators, to the noise of the moment, leaving us feeling adrift in uncertainty. But true financial mastery, as figures like Warren Buffett have shown, lies in cultivating an independent spirit, in being fearful when others are greedy, and greedy when others are fearful. This means moving beyond the passive consumption of financial news, beyond the superficial dogma, and into the sacred wisdom of data-driven truth. It means trusting your critical analysis, even when it challenges the prevailing lines, even when the world around you insists on a different story. The pain of uncertainty, the frustration of conflicting information, these are valid human experiences, and they resonate deeply, but they do not have to define your financial journey. This exploration is an invitation to build your own analytical framework, to become the discerning investor who sees beyond the illusion. It is an act of empowerment, transforming that uncertainty into a strategic advantage, allowing you to move from reactive to proactive. Cultivate the discipline to observe, to question, and to act with conviction, letting these insights be the balm that soothes past disappointments and the foundation for a future built on informed decision-making and sustainable wealth. Take a moment each week, perhaps over a quiet cup of coffee as the morning light spills, to truly sit with these indicators, not just to read the numbers, but to feel their implications, to connect them to the real-world flow of goods, services, and human endeavor. Let this practice ground you, turning abstract data into tangible foresight. As you look towards the horizon, what hidden truths are now clearer to your discerning eye, and how will you use this newfound clarity to shape your financial destiny?